You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 12/9/21. Well, market has been tumultuous. All markets have been tumultuous, whether it's cryptos, precious metals, dollar, stock market, interest rates, oil, all in flux. It's been a while since we talked to our next guest, Eric Hadik. Eric, you run InsideTrack.com. That's inside with two I's. And, well, it's great to have you back on. So what about the stock market here? I guess we should take a look at that first. It's certainly been most in the news recently.
Well, it's good to be back, Kerry. Thanks for having me. And as far as the stock market, I still kind of view it. I think the most important thing is to understand the bigger picture outlook, the 1 to 2 year outlook, and where we are within that. And I've discussed, and recent action has just reinforced and corroborated this, that there's been for many years a very consistent 16-month cycle in the stock market. And that has also broken down into very consistent 8-month cycles. And you've even seen that break down into 4-month and even 2-month cycles, linking important tops, important bottoms, and also giving a good idea of when to anticipate future ones. And one of the things that I've been looking at, well, throughout 2021 was the idea that we would see an initial peak in the May-June timeframe, which was 16 months from the January-February 2020 peak, which was the same interval from the September-October 2018 peak. And you can keep going back and see this sequence of 16-month turning points in the market. But the outlook was for an initial peak in May or June and a more significant peak in January, February of 2022, which is 8 months. It's the half cycle of that 16-month cycle. And in between there, seeing some decent sell-offs in the weaker markets, the weaker indexes. And that has typically been things like the Dow Transports, the Russell 2000, the S&P Mid-Cap, while other ones, the stronger indexes, namely the NASDAQ 100 and the S&P 500, would see brief interruptions to their bull markets, but then head to successively higher highs. And since that May-June timeframe, you've seen this sequence and you've seen a lot of divergence where those stronger indexes will set higher highs, even as a lot of other indexes and even more so a lot of individual stocks have already set peaks and are in a kind of drawn out topping process. And you get that a lot at depending on the time frame and the magnitude of trend you're talking about. You'll get leading or weaker or kind of canary in the coal mine type of stocks topping well before the rest of the market. And that doesn't mean that you're entering a bear market right away. It's just showing you that you're starting to get this this kind of trailing off of stocks setting new highs. And I always equate it to an old roller coaster that has, numerous cars throughout the train of the roller coaster. And each of those cars will hit the peak at a different time. And it's not until that last car finally summits and starts to turn down that all of those cars can suddenly go down in a significant and an accelerated manner. And the stock market is just like that. that you'll get until those final strong stocks peak and start to crest and start to turn down. The rest of the market will hold up relatively well. You'll get some decent sell-offs in those weaker stocks. But that's kind of the broad picture of where I think we're at. And I think that January, February is going to be one of those peaks where even the stronger markets, stronger stocks start to turn down. But the magnitude of that top, whether that's an ultimate top for a 1 to 2 year trend or the penultimate, the one before the ultimate, that's going to be heavily influenced by the action in the next few weeks. But either way, I think we are going to see an important top in January or February, most likely January, and that we will see a pretty good sell-off in the first half of next year.
All right, so we're looking at a sell-off. We had those gyrations. Were you surprised with the ferocity of the decline on the day after Thanksgiving? That is usually the most benign trading day of the year.
Well, you don't normally have a new COVID variant that has hit the markets while everyone was having their Thanksgiving turkey either. And so really Omicron came into the public's eye over that time frame. And so that sell-off was part of that. My outlook since late October had been that we would see an intermediate top in early November. November 4th to the 9th was the time frame that I identified in my publications, and that we would see a sharp sell-off in November, bottoming in early December. So pinpointing the exact day of when that fall-off comes, I don't claim to be able to do that, but the overall outlook was for a sharp sell-off between early November and early December before a rebound into January. So it wasn't any big shock other than the news that triggered it, and like you said, how significant it was just on a 1 day basis.
Yeah, it looked to me like even the A team traders, they weren't at their desks. The B, forget it. I think it was more like the D team was maybe at the desks, if anyone was. And I think once the market broke, the algorithms got triggered, and that was the end of it, that pile-on effect.
Yeah, you always get that in the lower liquidity days, that if something does trigger them, it gets amplified exponentially. So, yeah, I would completely agree with you there. And the markets recovered pretty quickly. They did follow through for a few days, so that kind of validated what had gone on there. A lot of times when you have something like that triggered just by the illiquidity, the next day, traders will come back and it'll snap back right to where it was the day before they went on vacation. This one had some follow through, so it told you there was some validity to it.
Interesting. Well, the market never ceases to amaze, right? All the years you've been following it, and then you have these bust outs, but you weren't surprised that it happened, perhaps just that it happened when it did. What does this mean for the dollar and for interest rates? Because everything's intertwined now.
It is, but, when you get individual moves like that, and even moves in the stock market over a few months basis, it usually doesn't have a significant impact on, say, dollar or interest rates. I do think, and I have contended since early this year, that the dollar would put in a major bottom in early 2021 and head up into 2022, 2023. That still is my outlook. That's partially tied to interest rates as well, as there's more and more talk and expectation of interest rates starting to nudge up. That helps the dollars, or at least perception of the dollar. But I think there's a lot of other factors going on there as well. I always caution against trying to trade or even analyze one market based on a single correlation to another market. And I've got a rule of, or an axiom of correlation that I talk about too, that, and there's two aspects to that axiom. One is that if you're going to trade a correlation, you need to know exactly what the traders are focused on every day, because there's always a different driving market. And sometimes that's due to a report that's just come out, and all of a sudden maybe bonds are driving the market action that day. Sometimes it's like over Thanksgiving, a external global event with the discovery of the Omicron variant. And all of a sudden that drives the perception for a couple days. And so unless you know each morning what, or, you know, nowadays with global markets, I guess each morning is meaningless, but each day you're going to have to know what that driving leading market is. Otherwise, you can't really trade correlation, because often you'll have two markets that should be inversely correlated, like, for example, the dollar and gold. I still have so many people tell me, you know, if I'm talking about gold and the dollar going a similar direction over a similar period of time. Now, the turning points aren't exactly, but saying that's impossible, you know. And yet, if things like, say the focus was on the euro, say for some reason there was a perception that the euro was weak over a 3-month time frame, well, both gold and the dollar would benefit from that. They would benefit at different proportions, and sometimes the exact timing of highs and lows will be different. But if you look at a chart and look at the trend over that time frame, you'll see that both of them trended the same direction over that same period of time based on the specific correlation that was driving them. The other part of that axiom that I really adhere or really stress is that the one time that markets will really step up and follow a strong correlation for a limited amount of time is when one of those leading markets has entered a parabolic phase or has broken through multi-year support or resistance. And that's when those correlations will work pretty consistently, pretty accurately. But even then, it's only for a brief period of time. So there are things that I'm looking at with the dollar and with interest rates, both that still tell me to look for an overall uptrend through much of 2022. But it's based on individual factors of each of those markets. And it's also not a straight up expectation. Like right now, I think that the dollar has hit a peak. It reached some critical levels. And I think that there's a need for a bit of a correction back to really a key breakout point that it had in the last couple of months. And so we're entering the phase where we could see some consolidation in those both dollar and interest rates, but within a broader uptrend in both of them.
All right. Well, sounds reasonable there. Precious metals, you'd called an intermediate top a while back, and you were spot on, right on the money. What's in your crystal ball here, Eric?
Well, when we got the top, it ushered in kind of a secondary, an initial correction to a secondary low that I am expecting in this time frame, and pretty close to where gold and silver have recently spiked down to. I think if you go back a few months, that late September, early October bottom in most of the metals and mining shares is a very significant cycle bottom that should continue to hold through the end of the year and into part of 2022. And that cycle, those bottoms, I think have significant ramifications on what I'm expecting in 2022. But for right now, on the intermediate time frame, like I said, I do think that gold and silver have pulled back and are in the process of making secondary lows. And this is one of those time frames where I think that some correlation could help them. And by that, I mean what I was just discussing about the dollar, that the dollar had been very strong for the last month and a half. And that was keeping a ceiling on gold. Doesn't mean that every day the dollar's up, gold is down, or vice versa. But that strength in the dollar is one of the factors that's weighing on gold. And it wasn't until the dollar started to accelerate higher and gold came into some intermediate cycles in mid-November that were expected to set a 1 to 2 month peak. Then the dollar entered kind of an accelerated phase up, and that's what really had a significant impact on gold and silver. But now with the dollar topping, and if we get a pullback when I expect it to, I think that gold and silver are going to have an opportunity to enter a secondary rally, which ultimately I think will take them above their mid-November peaks. And I'm looking for an overall uptrend into late February from where we are now. There's already a couple of significant cycles within that time frame that I think will time some swings. And I think that for over a year now, gold and silver have been like that. You need to be playing them on a few week basis, sometimes a 1 to 2 month basis. But if you get married to a position on either side, you're just going to get very frustrated because it is a lot of consolidation in a trading range. And I think it's still going to be some time before they are able to break out of that and go into a more sustained trend.
Okay, so kind of more of the same, but trending a little higher, perhaps, huh?
Yes, I believe so.
All right. Well, that's interesting. And we have no reason to doubt your call on that one. Energy. So we've seen huge moves in oil, in natural gas, new highs, intermediate highs, big high in nat gas. It hits 650 per million BTUs. Now they've pulled back. It looks like there's a pattern emerging in commodities. They have these big run-ups across the board. We've seen it in virtually every sector, except perhaps precious metals. Big run-up, hit new highs, intermediate or even all-time highs, as in the case of copper. And then they come down to earth a little bit, but it's still a higher low. What do we make of that?
Don't just survive, thrive. The Financial Survival Network.
FPX Nickel is developing the large-scale Dakar Nickel District in central British Columbia. Within the district is FPX Nickel's PEA stage Baptiste nickel deposit, which is projected to be among the world's top 10 largest nickel mines by annual output. The Baptiste deposit has the potential for the lowest quartile operating costs at just $2.74 per pound. And compared to recent global nickel mines, the project requires a low capex. FPX is also commencing its first ever drill program at its Van target in the Dakar Nickel District. Surface samples have indicated that the Van target footprint is larger in scale and 10 to 15% higher in grade than Baptiste. FPX Nickel trades in Canada as FPX and on the OTC under FPOCF. To learn more, go to fpxnickel.com. That's fpxnickel.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, I would definitely agree with you, and I think that this has all been a recovery and then some from the washouts and the meltdowns of early 2020. And for a year, you had kind of a recovery, and then those energy markets began to build on that upside momentum and go into a bit more sustained and a bit more significant uptrends through the second and third quarter of this year. And I do agree with you too about the ascending lows and the significance of that. I have been looking for on multi-year cycle basis. My outlook has remained the same in natural gas, that there were multi-year cycles bottoming in the first quarter of 2020 and peaking in the first quarter of 2022. And that between those two timeframes, I thought we would see an overall uptrend. More recently, when we hit that 650, it was fulfilling a lot of upside targets in nat gas, and it was time for a significant correction. And I'm looking at two key price levels in nat gas that are pretty close together, around 340 to 350. One is a level of the first high off of its low back in a little over a year ago. And within a whole wave structure, often that initial top is something that provides major support for a future pullback or correction. And there's also levels on an intra-year basis that are very strong support. So 340 to 350 is the critical level for me in natural gas. And it really needs to hold that for my expectation to remain intact, that we could head back to the highs leading into the first half of 2022. And as far as crude oil and the products, crude has been adhering to some strong cycles, but I've also been talking about for many months this idea that I just call it range trading. And you could see it in most of the markets that they will spend a majority of their time vacillating within equally separated ranges. And for example, in crude oil, it had really set a sequence of trading ranges that were about $11 apart. And if you took a 2 or 3 year weekly chart and you just drew horizontal lines at $39, $50, $61, $72, $83, you would suddenly just kind of step back and say, wow, crude, it'll trade within one of those sets of ranges. So between 61 and 72, trade in between there, highs and lows hit. And all of a sudden, when it breaks above the 72, it heads almost directly to the next one, which in recent case was 83. And once it got up there, then all of a sudden it just starts hesitating and goes into a topping pattern. And when it finally confirms a top, what's it do? It drops right back to 72. And in this case, as soon as it broke under 72 within a few days, also due to the COVID news of late November, early December, dropped through that 72 support, and within a few days was attacking the $61 level and found support there again, snapped right back up. Where's it trading now? It's coming right up into the $72 level. So those ranges have just continued to bracket the trading action in crude. And that was why in late September, when we finally started to break above 72, I was explaining to my readers why, for a lot of reasons. I don't depend on just one indicator or one factor like that. But for multiple reasons, I thought that crude would shoot up to the $83, $84 level and then set a very critical top there. And that's where we ended up peaking in late October in crude. And I expect it to kind of continue to trade in those type of ranges. And that I do think that late October peak is going to continue to hold through year end. And crude might have a chance to retest that leading into some cycle highs in early 2022. But for now, I think we're going to see some volatile trading within a wide trading range.
Interesting. Well, the commodities kind of all following that same pattern, though, of kind of explosive, almost parabolic move higher and then back down to earth. So for the coming year, commodity prices, industrial commodities, energy, metals, what are you seeing?
I think a lot of them are entering a topping process. I think we've seen the parabolic moves. We've seen some pullbacks and in many of those commodities rallies to subsequent highs after the parabolic move. And I'm just seeing signs of many of those commodities hitting some crucial upside targets, running through some important cycles. I'm looking at things like even as diverse as, say, coffee and copper and cotton. I'm not trying to do alliteration here. They're just a few that came to mind all of a sudden. But they all had some very significant cycle tops during the fourth quarter of 2021. There's a few others that I think still have another leg up in 2022. But you've got several factors that I think are starting to come together that will begin to weigh on those inflationary pressures. And, you're steadily getting some of the supply chain and shipping issues slowly resolved. But as more and more supply hits the market in all those commodities, and as normal, the pendulum always swings too far to one side. So all that supply backup will suddenly probably lead to, a year from now or 2 years from now, oversupply in a lot of things. And you're also seeing, as we were talking about earlier, the dollar and interest rates starting to edge up. And I think that they'll see some more upswings in 2022, and both of those tend to weigh on commodity prices and weigh on inflationary forces, that being higher dollar and higher interest rates. And I think that there's some other factors too there, that even the fact that if I'm right that the stock market is going through a topping phase, once that rolls over and starts to turn down, that could also weigh on those inflationary forces. So there's several either developing or anticipated factors over the next 6 to 12 months that I think can stifle the inflation that we have seen of the last year and a half to 2 years. And again, I always stress to my readers and listeners that you have to also just put all of that in perspective. Yes, we have seen some true commodity inflationary forces, but you have to go back to how negative that pendulum swung in March of 2020. And, when you saw the front month of crude go to negative $30 or $35 a barrel, who ever heard of a commodity going into a negative price? And things went so extreme there that if you look at, say, March through September of 2020, where you had the sell-off and the whole bottoming phase, and then you get year-to-year inflationary measures in March through September of 2021, well, even if all they had done was return to an equilibrium point, they would have looked like they were significant increases over where those levels were a year before. And so you've got some real and some imagined pressures there. And again, the whole supply chain and labor shortage has also played a key factor, which the big question is whether that's temporary, as is expected to be, or whether there are some real paradigm shifts that happen as a result of the pandemic. So there's a lot of factors, like I said, that I think can begin to provide a ceiling over commodity prices and inflationary pressures in the coming year.
All right. Well, that's an interesting year ahead of us. It sounds like it's going to potentially go contrary to the large expectations, mine as well, that inflation is baked in the cake. It makes you wonder what the economy is going to look like, because it looks like there's a choice of either economic growth with lots of inflation, or maybe not growth, but staying where we are, equilibrium, or if rates go higher and inflation goes down, potentially a real economic reverberation there on the downside.
Well, and even like you're saying that economic recovery, perhaps staying where it's at, everything in the markets is anticipated, usually 3 to 6 months out. And if the most bullish scenario is baked in the cake already, then what is there to drive it farther? You would need to have not only a status quo hold in the economy, but you need to have continued signs of new growth and expanding growth. Otherwise, the markets, that pendulum then swings too far to the other side, that traders get disappointed by numbers that are just status quo, or just, kind of flatlining at that, not turning down, but just plateauing would be a better phrase. All of a sudden, they've anticipated higher growth, and now the realization of just steady growth is a negative based on those future expectations. So then you get the selling, then the market goes farther than it should, then that has its own reverberations on commodities inflations. We see these swings. It used to be on a more widespread interval or time frame, and now it's happening every couple years or more frequently. You look at late 2018 and then early 2020. Now, we haven't had much like that lately, but you get those wide swings and those overreactions once things plateau and even give the slightest negative signs. So that's what I think we are more likely to see out on the 6 to 12 month horizon. And it doesn't mean that the economy or the stock market goes into a full-blown bear market, just that it corrects what has been a extremely overdone bull market of the last 18 to 20 months. All
right. Well, it's going to be really interesting to see how they put this inflationary genie back in the bottle. They don't really have a lot of choices. Higher rates, tapering, slowdown of credit creation. What other tools does the Federal Reserve really have in its arsenal? And then, of course, a recession, which is in itself anti-credit creation and more deflationary. So which of those things are going to happen to take to pop the inflationary bubble? Going to be interesting to see. I think we covered a lot there, Eric. If you want to find out more information, Eric, where's the best place to find your work nowadays?
It is at our primary website, insidetracktrading.com. And as you pointed out in the beginning, the word inside has an extra I in the middle since it's an acronym, but it's INSIIDE, tracktrading.com.
All right, excellent. And if you got a question for Eric, myself, shoot us an email to kl@kerrylutz.com. Eric, always a pleasure. Thanks so much for stopping by.
Thanks for having me back, Kerry. It's my pleasure.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.